Hello, Warriors. Let's have a great week. Sinatra, Angelo, Richard. I don't know who the founder is. Mike, how are you? Mary? Okay, I am. All right. Good club. You know, any club that would let me, be part of my club, I wouldn't want to join. Good morning, Richard. Good morning, team.
Morning, Dale.
Good morning, how are you, Ryan? Hey, Kay.
Good morning, guys.
Hey, Steve.
Morning.
So we're at full strength today.
Full power.
Full power, like silver is. Bears, you bulls that were afraid to get long. Here's gold too. Maybe we threaten this breakdown this week. Yeah, I have a great guest, guys. You have to stick around for Jamie McGeever today at Reuters. Jamie. So Jamie's going to have some interesting things to say about what's happening in foreign exchange, as well as the Fed. So good timing to have Jamie with us. So why don't we start here, guys? In Europe, enlighten us here on this side of the world with anything that developed, getting followed through in cable, not so much in euro, and yields are down sharply, and the yen is still higher, but off its highs. So there's yields. K-Man, let's start with you.
Hey. Yeah, it's shied away quite well from the 4% in the US 10. So I guess the whole market is now hanging on to that. What's going to happen there? See what happens beginning of October. And I don't really know. I think somewhere around here is actually support, right? 370-ish. We've seen prior lows
right here.
Yeah, right here, just in the short term. It's also been kind of a springboard before going to the 4%. Yeah, it's going to be.
On the other hand, a breakdown here.
Come again.
Just in case it happens. I mean, it would take you to 340.
Yeah.
And wouldn't 350 be a natural place for it to go, which was the prior high anyway, to test it out?
It could be if we continue to go to grind lower. There's a bit of a channel there coming from early August, and that would point that somewhere around in the mid 350s somewhere.
Okay.
All
right.
It's all possible on whatever rebalancing they still need to do, and people again now starting to hope for not a Fed pivot, but saying, yeah, we could go a bit too far and then having to screw back. It's all the same. Every month we start with the same things all over again. On the dollar yen, I think pretty neutral, but as long as we stay above that 143 on the shorter term, 143.90, 144 the figure, I'm not inclined to buy too much yen for now. I wouldn't be surprised that if yields hold up around here. It will all depend on the data. I think data are going to be important in October again, but if it holds, if it breaks below 143.90 figure, then I can see it's deeper again, naturally. It has to come naturally, not via intervention.
Okay, because I was kind of thinking that maybe there was a chance if yields stabilize and make a push, a failing rally or something, that we would test out the BOJ.
Yeah,
see if they come in again.
Yeah, it's from where we are. If we listen and take his word for it of what Kuroda said, is anywhere 200-300 points, but in fast succession, then they should intervene. So if you take the 200 points from here, that's 147, and up there's a few targets waiting in the 147 if ever we would get there. Just okay. To measure a level where Bank of Japan or better said MOF would be interested.
Okay, be interesting to see, you know, what kind of RSI reading we get up there if it fails to confirm on the daily.
Yeah,
Okay,
it had time to correct, right?
yeah, yeah. I don't know. Maybe there might be destiny for one more high. Commodity currencies are weaker today. I put this out on Twitter when we were here that we had a 3 drive. So far, it's working. And what was interesting is, although Canada made a new high, Aussie put in a higher low, and you know, it looks okay.
Yeah, just a quick one on that. It seems that in the euro crosses we are undoing what we have been seeing at the end of month, end of quarter. We have seen those euro crosses ramp higher. Euro Canada, Euro Aussie, Euro
Yeah,
Kiwi, really ramp higher, and over the last 2-3 sessions, and now we are in the process of undoing it. Euro Canada here back on 134 is pretty.
yeah. Look, a euro pound from that spike on the BOE intervention looks really ugly. And Stelios had that target of 92 for being long
I
and
was
being
saying
short.
90. I was saying 90, but obviously it overreacts when things get really
Oh,
messy. But
I
anyway,
remember
you know,
saying 92. And
I-
anyways,
yeah.
I'm old, so
No. I did mention the 92 level as well, but really my target was 90. But you know what I don't get is obviously Kwasi Kwarteng, the Chancellor of the Exchequer, took back the what he had announced about the 45% tax bracket, and the markets are happy about it. And for me, it just shows. I can't see this favorably, at least not in the short term, because it just shows they're kind of making it up as they're going along. You know, it's like so. I mean, I don't know. I don't know what to make of it. I think this rally in sterling is probably a selling opportunity. I think. So you know, there will be a time, in my opinion, to be really bullish the pound. It's just not yet. Not for me.
I read from who was it? Peter's going to be with us Tuesday. That in order to arrest it and have an overlap in cable, you need 114, and that would do it. And look at where we're at. We're right against this. What was a return line that? Wow, one hell of a throwover. I remember here saying cable wasn't as short at 114. Well, it wasn't for just a few days, but I never expected this.
Yeah, nobody expected that, I don't think.
Yeah. So there's starting to be some talk about concerted intervention, even though the Treasury came out and said they don't need an accord. And we'll be talking about that with Jamie today.
Well, you know my view. I think it's coming eventually. It's coming sooner than people expect, and especially if we see. I mean, not especially. You know, only if we see another kind of
retest.
Retest and more panic in the markets. Yeah, when we see, not necessarily in the pound, but in general. You know, if bonds start going again and we get a little bit more panic, I think they're going to step in.
I'm going to be once again annoying.
Okay.
Saying that the only intervention that is eventually going to work is normalizing monetary policy. No other intervention will have a long-lasting effect.
I'm not talking about what's going to work. I'm just saying what I think is going to happen.
Yeah. I'm with you. I'm with you. The central banks have a magnificent track record of making mistakes.
Yeah. Oh my God.
I actually think it'd be a nice band-aid, and it you know, why not make the dollar the sacrificial lamb? They could continue it would give them cover to continue to tighten, because it'll take some pressure off international markets, and it'll make US inflation even stickier, because the dollar, you know, will import inflation back here from exporting it everywhere, and that gives the Fed more cover to continue to tighten. You know, prices will be, you know, higher because just nominally with a weaker dollar, and they could say, well, look, you know, inflation's not coming down, we have to continue.
Yeah,
What do you
could
think?
be.
I mean, it's happened before. I know everyone's so skeptical about it, but there have been more than one successful concerted central bank intervention, especially against the yen. So, and it's the same thing as saying, well, it won't work. Well, it's like saying, well, QE won't lift markets. So,
Yeah.
I mean, why won't, that it doesn't work? Well, yeah, it didn't cause real economic growth, but it certainly worked and levitated and inflated asset classes.
If your time horizon is short term, yes, it absolutely did.
Sometimes, what could happen if they turn the dollar and that happens, and then the U.S. will say that's enough. It won't be so easy to turn it back around. So, no one will be in favor of it either. So, it could last for years. They've had interventions that have had long-lasting effects. So anyway, we'll see. First of all, let's see if they even do it. And I think you're right, Stel, that why would they do it now? They do also, people are saying if they're going to do it, they may do it at this. I think there's a G10 meeting coming up on the 12th of October and use that for a platform. But you know what? Why not use surprise and do it when people aren't thinking that you're going to do it? So
nobody expects the Spanish Inquisition, right?
Yeah. Yeah. Why not do it by surprise? And you know what? Why not do it before the market's under duress on a retest too? So I mean, I was thinking, why would they use their bullets if they didn't have to? Well, it might be easier to do now than if there's another episode. What do you think, Ryan?
Yeah, it's weird, isn't it?
I need to be put on some
In a straitjacket?
stabilizing medicine and
no,
take a vacation.
my overriding thought is, why would they intervene in the mess they've already made by their policies? So they want to use policies to fix a problem they created in the first place. Oh, mind you, that sounds like central bankers in a nutshell, really.
Yes.
I'll shut up.
Exactly.
Yeah, it does. Yeah. Well, who trusts them for a soft landing? But they're central planners. This is a play they have in their deck if they want to use it.
It's a big rabbit hole, isn't it? When you want to get down to what central banks should do, would do, can do, and do.
Or why they're doing it.
Yeah.
Because you ever think, look, we get to talk to really great minds. And for how long have we been having guys like Eric, and I've had so many economists, Lakshman, all these guys saying the economy was weakening, maybe at the beginning or prior to the Fed beginning to hike aggressively. So you don't think the Fed has access to smart guys like this, that they don't know? They don't know what Eric Bausagian knows?
They were cutting rates. They were cutting rates late 2019, just before COVID hit. Remember?
Yeah. So why are they doing it? I mean, they know they're tightening into a weakening economy. What's really the mission?
Because they
know if we get great ideas and research about what's happening in the economy, you think the Fed can't source that kind of material?
Yeah, but their credibility got shot to bits when they spent 18 months or whatever it was telling us, A, there's no inflation, B, inflation is going to be transitory, C, we don't know where inflation's going. That was their exact words over that time period. They had their trousers pulled down, and now they've got to be seen to get that credibility back. So they're fighting inflation, whatever it does to the economy, and they'll probably get a spanking for that as well.
And the reason why, and good morning, guys, is because inflation, they know, is everybody knows that inflation is one of those psychological phenomenons that once it takes off, it's really hard to contain. You have to take really strong efforts to contain it, or it'll go out of control. And no one wants to be in a hyperinflationary environment, right?
Yes, that's why for decades central bankers used to say that inflation is a genie you don't want to let out of the bottle.
Right. And so
and then they went and ignored it.
So just to answer your question, Dale, the reason why they're fighting it so aggressively is for those reasons, right? I mean,
Yeah.
that they want to make sure they can contain it so it doesn't continue to spiral out of control, and we turn into the next some American country that has hyperinflation.
Yeah, but
what they're trying to point.
I mean, can they really fight that battle? Well, OPEC makes a decision and crude's up $4, where it's more about supply. Every problem they're trying to solve with monetary policy needs to be solved through, good fiscal ideas, like, build pipelines in the US so natural gas could flow all over the place. Or there's a housing problem. Well, build low-income housing, give tax incentives to do it. There's not enough grain. Give farmers more incentive to grow more grain. And I just want that's how you solve a supply problem, right? Not by tightening so that people eat less soybeans or less wheat or corn. Anyway, I want to just show this. You know what
go
I'm
ahead.
saying? All right.
No, I was just going to say, but that the Fed is the Fed. The only lever they have is to deal with rates. You're talking about fiscal, not monetary, fiscal issues, and that's I mean,
it's just bad policy that the Fed can't solve.
We're in a political disaster area. Doesn't matter on what side of the aisle you're on. It just doesn't matter, right?
Well,
so
people aren't going to go on a diet because the Fed raised its rates another 75 basis points. So I don't know how it solves this, but grains and food and agricultural commodities. But I just want to show this. Here's corn. Doesn't look bad, right? Beans look pretty bad, but the market that's really starting to come out of here is wheat. Okay, much more than corn.
Wheat's got a beautiful just a base developed. It looks like it's going to actually rip higher.
Yeah, look at if it just retests the war, and this looks like a big, maybe this is the cup of a cup and handle anyway, but that's wheat. There's a lot of, you look at like cotton, soybeans don't look great. There's a lot of commodities that just look rather weak right now. But I was pointing out wheat because why do you think wheat's acting better than corn or beans?
I guess it would be all of Eastern Europe, right?
Yeah, Ukraine.
Yeah.
If he blows off some nukes, those wheat fields will be irradiated for 100 years.
True. It's a good point.
So I think that's part of it. Anyway, okay, I know I've cheered everyone up.
My goodness.
I'm going back into my bunker. Huh?
Deep for a Monday.
Huh? I'm a
happy Monday, everybody. Welcome back to
I'm
trading.
a crabby son of a bitch today.
Have a great week, everybody.
What did you guys cover in the flow show today that was notable that we may have missed?
Well, he was a bit more cheery than what Dale had to offer anyway.
I know. Between him and Steve, I'm actually going to go outside and start mutilating myself.
I'm sorry, I cannot talk about the flow show. I'm crying after the last 3-4 minutes here.
Right. Well, looking
sure you
around,
are, Iceman.
It's obviously been a pretty quiet session. We're seeing equities trying to recover a bit. We've got the S&Ps that are back above 3,600.
Yeah.
Do you guys believe it? Do you guys think that we have room to rally here and risk? Do you think that that selling that we saw on Friday? Joe was in our chat room. He said it to me. A lot of window undressing.
Yeah, they didn't want to show the losers on their books going into.
Now you're putting them all back on. What do you guys think is moving the markets here, and do you trust it? So what do you think, Ryan K-Man?
Well, you got this bit of messing with Credit Suisse going on. Rumours over the weekend of a bank in trouble, and Credit Suisse is in the frame as per usual. Never one that's far from the headlines. That's taken a battering. Be interesting to see what the US does with it. Not a lot at the moment, but keep an eye on stocks there in case this rumour gets picked up. But yeah, we're just coming off the back of month end, so it's quarter end as well. So the first day of the new month, there can be a little bit of jiggling around as people get positions back on and so on and so forth. Dollar yen up through that 145 briefly. So the gate was off of that one, very, very tight in that pair last week.
Yeah.
The volatility we had. So keep, it's always looking for the little signals. If it gets above 145, starts to hold, maybe we get a push up towards the highs.
Ryan, Deutsche Bank not far behind Credit.
Oh yeah, exactly. They're always one step behind.
Yeah.
I just want to say regarding
buying Credit Suisse, that's when you go short everything.
Regarding the bond market, if you look at the 10-year and you look at the 30-year, we're obviously seeing a reversal on bonds here. I'm not sure if it's a flight to quality or just a oversold bounce. But one of the things that I want to point out is that we had these the overthrows like in yields that Dale loves, and you got to watch the support. I mean, if we start taking out the support and then get below 350 on the 10-year, I mean that's going to show us a bearish reversal here. So and that might improve what happens in the equity markets too. So it's something that I think everybody should be paying attention to. This maybe peak that we see in yields and lows that we see on bonds. I was going to ask you guys, we have the jobs report that obviously, this Friday. What do you guys think is going to happen here? I mean, I'm looking, well, I'm hoping, I shouldn't say I'm looking for eventually for economic data to start to weaken. And let's, just go over to Forex Analytics really quick. We'll just go take a look at the calendar. If you take a look at what the market's looking for, about 250,000 jobs, average hourly earnings are supposed to, print in line, in year over year, slightly lower, but basically in line. I'm really hoping that we start seeing some weaker economic data, starting with the jobs data, because if we do get that, we will get a recovery in stocks. And I think that this is a really nice setup if we can hold these lows in the S&P. A lot of people are targeting lower than where we're at. I mean, everybody's like technical targets come in around 3,400. I mean, that's the head and shoulder pattern, channel support, everybody's looking for 3,400, but we're also down 6% on the year currently in the S&P. I mean, can we be setting up for a nice rally into the fall if we start to see economic data weaken a little bit? So what are you guys looking for? Let's start, Stel. We haven't heard a lot from you. What do you think is going to happen this week as far as data goes? And are you looking for a weaker jobs report?
I think weaker numbers are coming because this is the effect of tightening and the way demand gets destroyed.
Right.
The question is, will it come this week? I mean, I don't know. You have to be a magician to know. For choice, I'm starting to think that I'm starting to go that direction, so that the data is going to start coming in weaker, but I'm not convinced it's going to start just yet. That's the thing.
Okay, that's fair enough.
Sorry, I'm not very helpful. Sorry.
And by the way, you guys at home, you guys, may have your opinions, but make sure you voice them this month on the on. Ryan, you're gonna run a special, right? Or are you out this week?
Yeah, I'm gonna run the competition. I'll get that out either today or tomorrow. So we'll get it up.
Yeah, make sure.
Wednesday off to. I'm going to invade Belgium because Kay said no one's invaded it for a few years.
So you're gonna go invade Belgium for your birthday, and I'm assuming you're gonna drink beer.
History has proved that that's a very easy task, by the way.
Yeah, exactly.
All right. So, all
about
right,
that?
sounds good. So, if you guys at home, you have your opinions on which way the jobs, what the number is going to be. Make sure you participate in this week's, non-farm payroll giveaway, because we will be giving away Forex Analytics at least 30 days. And by the way, our pricing is going up. We have it priced at $99 a month, and you can see that we also have semi-annual and annual. That price does go up. I thought we were putting it up this week. When are we raising that price, Steve?
Probably at the end of this week.
Okay. Well, I thought it was going to be the end of last week. So you guys are in luck. So make sure the price is going to 189 and it's not coming down again. So just everybody hear what I have to say about that. I thought they were going to be up already. All right. Sounds good. Well, Steve, what do you think is going to happen with the jobs report? Do you think this is the month that we start seeing weaker employment?
I'm going to give you the same answer I gave you the last few times you asked this question.
Okay, then I'm going to move along.
Okay, go ahead, move along.
Go ahead, Steve. Just quick answer. What do you got?
It is very quick. I'm not in the game of predicting if it's going to be this month or the next one or whatever. But for sure, we're headed in the direction that job data are going to get worse. So it's a matter of when. I don't know if it's going to be this is going to be the first month or the next one. We'll have to find out. But I expect it to happen and happen sooner rather than later.
All right. K-Man, what are your thoughts here with the jobs data? And I think we probably have to start off with seeing what's happening with like all the ISM data coming out this week. We do have, obviously unemployment claims. We've got job openings. We got a lot of employment data coming out this week. But what do you think, K-Man?
Yeah, I'm of the same opinion. It's going to start to turn, but I still don't know when it could. But it is already turning just a little bit, right? But we need to watch the participation rate to compare it with the unemployment rate. We could start to lose a few jobs, but we will see on the ISM. But yeah, as you many times asked the question, when is it going to turn? When is it going to turn? It could be this month. It could be next.
Oh, well, yeah, okay. Well, let's see if it does happen. By the way, this is the Forex Analytics community, just in case you guys want to see all the conversations that are happening. And K-Man's bringing it to everybody's attention, and Stelios did too. Kim Kardashian pays $1.3 million to settle crypto charges. That's it? That's like
bullish.
that's like a slap on the wrist, right? It's nothing. All right. Well, me personally, I think the jobs data is going to start to show some signs of weakness starting this month. So, and that is going, if we do start to see the economic data, especially the jobs data, start to show some signs of weakness, that should be very supportive of equities. And so I'm going to warn everybody that, we're holding these lows right now. And if we can get, if you think about like the analysis, what, technicals, the S&P actually came down to the breakout point over here around 3,600, could go a little bit further at the bigger breakout point, but that took us a long time to get above that. If we hold these levels, we could really, trade a bigger double bottom, or, just really, strong support, if you will. Then that might, eventually get us up to 3,900. So I think you got to keep an eye on equities. Oh, I also want to point out that gold is firming up right now. Do we have any data coming out still?
Nope.
Okay,
Later today.
Okay, later today. What do we got later today?
ISM manufacturing and that's it actually.
It's one of those weeks where we actually get we get ISM manufacturing and services before the jobs report, which is nice. That's always a benefit. Take a look at gold here and silver. Silver's getting really close to what I would consider a breakout point. I know, you guys follow silver very carefully, but I'm watching this dotted trend line right through here. And gold, if we start getting above, 1690, 1700, that is going to be a massive reversal in gold. I think you got to keep an eye on these. And then obviously, if you have gold that's making a move higher, or precious metals in general, you have to be careful with the dollar, because the dollar might come under some pressure as a result. So anyway, so I'm going to say, guys, if you haven't taken advantage of Forex Analytics, we have a lot of people that are coming in right now. Our pricing was at $119 per month. That's what we normally charge. And we brought it down to $99 so you can lock it in and be grandfathered. Because once we move it up to $189 a month for our service, then we are not going to come down in price. So, and that is happening since we haven't raised our prices in years. So make sure you guys take advantage of it. Steve says at the end of this week, looks like you guys got a couple more days to lock that in.
And also remember, sorry to interrupt, remember you can get free access to Forex Analytics for a certain period of time when you take the trader funding program. So that's another motivation to try that out and trade with our money, not yours. And depending on the account size, you get free access to our service. So we want to be there for you and help during the journey.
Yeah, that's the most important thing with the trader funding program is first of all, we don't put a time restraint on you guys and gals, and then second thing is you're in our community. I mean, look, I'll just give you an example. Like here's the trades room, and I just started adding to some positions down here, and you can see like these are my positions, and I have a running total when I get out, get in, and you don't have to trade with the trades that I do, but at least you have a good idea of what we're doing in the market. So so make sure you jump in the trader funding program. Also, Steve, can you tell us a little bit about the event that's happening here?
What? Do we have an event?
We do.
Damn. I'm going to put the link on the chat box.
Nobody let me know. What can I say? It's our fourth one, and I think we've managed so far to make everyone better than the previous one. The list of speakers is excellent once again. We're going to have 2 panels. We're going to have 1 debate. The schedule is going to be the same as the 2 last times. So it's going to be Friday afternoon, and then Saturday and Sunday, big part of the day. It's free. There is also a giveaway, by the way, 2 iPhone 14s for people that register. I forgot to mention that the other day. Bottom line, I see no reason why somebody wouldn't want to be there, or at least have first access to the recordings.
Yeah, and so make sure you do register, because if you're not going to be there live, you will get the recordings shortly thereafter. I'm actually excited to hear the Danny Blanchflower Peter Schiff debate. That's going to be a good one. We're going to throw Dale in there and make him moderate. I'm joking, Dale. I don't know what's going on with that, but that is going to be an interesting one, don't you think?
Oh yeah,
that's going to be a good one.
All right, well, personalities.
You have a guest coming in, right?
Yeah, I have Jamie McGeever of Reuters.
Oh, that's awesome. Well, what a great person to talk to, especially in light of what's happening in the UK. So I'm going to go ahead and make sure, well, Stel has put this link in there. Make sure you guys register. This is a free event. It's free for you guys. And if you can't be there for one of the days or both of the days or all 3 of the days, but you're going to, because you're traveling, just register, and then you'll get the recordings as soon as we publish them. So anyway, that's our Trader Summit event. It's going to be awesome. I'm looking forward to it. And Dale, have a great interview with Mr. Jamie. He's one of our, well, he's one of my favorite, reporters around. So you guys make sure you stick around. I'm sure he's got a lot to talk about with the UK and Bank of England.
Yeah, he has some points we're going to cover. If I could promote him to a panelist here. Jamie, you have to allow me to promote you. There we go. Welcome back, Jamie. Welcome back to F.A.C.E, Jamie.
Great to be here. Can you see me okay, or hear me?
I can hear you. Do you want to use your camera?
Yes, why not?
Okay.
Apologies in advance to your. There we go.
Perfect. Okay. So Jamie, really a fascinating time. We're seeing market history being made, especially with what happened at the BOE. It kind of gave people an inkling of what a sovereign debt crisis might look like. Is that correct?
Yes and no. I mean, certainly, I think yes. When you use the word crisis, is it a sovereign debt crisis? I'm not quite so sure. I mean, when we talk about sovereign debt crises, we think of the Eurozone 2011, 2012, emerging markets. Those are sovereign debt crises. This, I think, is more, there was malfunctioning in the UK bond market, in the gilt market. So the Bank of England felt it had to step in. I think, as we all know now, as we're seeing the reporting unfold and the explanations come in, it was to do with the pension funds in the UK. Their leveraged positions, their derivatives holdings, basically for their funding, pension funding, was exposed to sharp rises in interest rates. Ultimately, that's the crux of it. Of course, interest rates shot up, yields shot up a couple of weeks ago with the government's badly received fiscal plans, and these pension funds were hit hard, and the bank had to step in. So it was more of a financial stability issue, I would say. Of course, that played out in dramatic fashion in the bond market. We saw a record rise in 30-year bond yields, 100 basis points in a day or two, and then when the bank came in, lo and behold, about 100 basis points fall in the next day or two. So, huge swings in the UK bond market. I think we're entering a period of calm, relative stability now, but how long that lasts is open to question. And the big fear, of course, for global analysts and investors and traders is that there are similar problems in other pension funds markets, whether it be in the Eurozone and Europe, thinking the big Dutch funds, or even in the US. And
Yes,
we just
even
don't know
in the
what's
US.
under the hood just yet. We just don't know what's under the hood.
Yeah, why don't we just touch upon why there would be a pension crisis? Could it be all the years of central planning that people that were managing pensions needed about 7-8% returns to keep it solvent and growing?
Yeah, I mean, I'll put my hands up and lay my cards on the table. I'm not a pensions expert, but I think from what I can see, I think not just in the pension funds world, but in the investment community, the broader investment community at large, the last 20, 30 years, we've obviously seen, we've seen interest rates and bond yields come down hugely. And certainly since 2008, they've been anchored, interest rates anchored mostly at zero. So to try and juice returns and to generate returns for investors or pension holders, pension funds have had to do a bit of financial jiggery-pokery when it comes to the derivatives markets, and to try and generate those returns. Their derivatives exposure has been, as we're finding out now, exposed to quick changes in interest rates. If you've positioned yourself for a low interest rate environment for years and decades, then any quick change in that is going to, it's when the tide comes out, we find out who's not wearing any shorts. And I think the reversal was so rapid, so sudden, that we saw that there were huge issues with funding. And so it's just basically another example of having to adjust and readjust to a non-zero bound, low interest rate, low yield environment. And 2022 has seen a pretty dramatic turn in that. And that's not going to come without any casualties.
Yeah, 40% decline in TLT is a proxy for 20-year, you're talking about treasuries here. So what's happening in corporate bond markets, and I'm sure they own some junk too. People are taking 30-40% unrealized losses at this point, right, on their bond portfolios. So the coupon doesn't mean anything, does it, when you're taking those kind of losses.
No, I mean, you want to get paid back, of course, but if you're taking those losses, then you know, that's a hard one to swallow. I think the corporate bond market so far has held up reasonably well, but I think that might be starting to turn as well. So we're in sort of kind of uncharted waters now. And I suppose the question from a stability point of view, as the Bank of England has highlighted, is, you know, at what point, or do we get to those points where financial stability concerns are such that central banks and authorities are going to have to come in and, you know, put a floor under this or stop the rot, or, you know, there are certain aspects or certain points in these markets that needs to be fixed and shored up. And I think we might be entering that kind of phase now, with interest rates so, you know, so relatively high. I mean, 4% interest rates, 2, 3, 4% rates is not high historically speaking, but compared to the last 10, 15 years, when we've all become accustomed to basically the zero lower bound, is quite a change in mindset for investors. And you don't need me to tell you how this year has panned out. It's a huge adjustment process.
So when we look at really the wrecking ball, why don't we get to the dollar, because you wrote a piece about it. I was going to show it. I'm looking for it, but excellent piece you wrote on it, Jamie. Let me just find it.
Yeah, the wrecking ball. It's a kind of hackneyed phrase, but I think it's true. I think it's certainly playing out. You know, the strong dollar is just a wrecking ball for the rest of the world, and it brings to mind that, you know, that famous quote from former Treasury Secretary John Connolly, basically, our currency, your problem. And that's certainly been a truism for 2022. It tightens the strong dollar, tightens financial conditions, emerging markets and overseas borrowers who are exposed to dollar borrowings and US borrowing costs. They are, again, it's just another example of having been used to what we thought was one stable world of investment and this sort of global structure of finance, of low interest rates and zero lower bound and low bond yields, and a relatively, you know, sort of softish dollar. That's completely turned on its head, and the dollar rising is just causing huge problems in world markets for, well, pretty much everyone except the US, but of course the US is not immune. And I think that may be the next shoe to drop is the US economy. And
well, we have heard
multinationals
push back and use the strong dollar is hurting the bottom line of earnings.
Well, we get earnings season starting, and I think it's next week is when it really kicks in.
We've already heard it from companies, though, complaining about the strong dollar. You know, that just started happening the last couple of months. They didn't hear about it, but now they're saying what a headwind it is. So is that the main problem, or are we also having problems exporting? Because I don't know what we export, maybe agricultural commodities, but are we having trouble being an exporter?
It's not showing up in the, it's not showing up in the data yet, but of course, you know, trade data is notoriously, it comes with a lag, and the effects and the, you know, the impact of exchange rate moves again take you know, months sometimes to filter through for companies to change their business plans. I think we may start to see that in the months ahead. We may see that come through into the hard data. But as you say, companies are certainly talking about it now. They're complaining about it now, which just gives you an indication of what's to come in the coming months. And it may not be too much of a stretch, although it's maybe on the margins just now. But if we're seeing all these central banks around the world, just spoken about the Bank of England having to intervene in its bond market, but in terms of foreign exchange, you know, the Japanese have intervened.
Right, they started it.
They've started it. Now, the Japanese are notorious interveners, if you like, but for the past 20, 25 years, it's been always to on the other side, it's been dollar buying, hasn't it?
Yes.
This one is, again, turned on its head. They've been buying yen for the first time since 1998, and other central banks in Asia are buying their own currency to try and lift them up from historic all-time lows against the dollar. Even the Swiss National Bank, can you believe it, is intervening again, in small amounts, but it's symbolic. They're intervening to buy the franc, having spent about 350 billion francs in the last 6 or 7 years on the other side. So it's quite a major shift, and I would not be surprised if the dollar rally was to continue, that we do start to get some sort of some noises from G7.
Okay, so
Not at the behest of the US, but
more
from
than
other
noises.
central banks. Yeah, more than noises. Other central
Okay.
banks, other countries are going to be putting pressure on Washington to at least recognize that this can't continue.
Don't you think
And
they're
it's-
doing it already? You think we need a retest of the pound going under 104 for them to want to do something? Do they have to be? Because that's what that's what I would think. Why use any ammunition as long as the market's doing their job and we're respecting the levels? Like what was it, 146 yen? That's where they came in.
Yeah,
And where the BOE came in at what, 104,
103. Yeah. Well,
103.
don't forget the BOE didn't come in to intervene on the pound. It came in
Right.
to intervene in the bond market. Of course, that had a direct impact on the pound, and we're back up at, I think, what, 110, 112 now.
Yeah.
So again, a period of relative calm and quiet on the FX markets. But were sterling to head back towards parity or back to those lows, again, the UK has got a current account deficit of around 8% of GDP. It relies heavily, to quote Mark Carney, on the kindness of strangers. UK assets, if they were to go down another 10% in price again, and we get ructions in the bond market and parity with sterling dollar is back in view, it's unthinkable that the bank wouldn't be having those chats behind the scenes with Washington and at a G7 level.
Don't you think it's going to take more than a communique? It's going to actually take the action. Do you think they could jawbone this for a while?
I think that would be the first port of call. Do you not think? I think they would start by firing a shot across the bows. They would maybe come out with a communique, a statement, and portraying a united front. From what I can see, G7 over the last 25 years or so, if the G7 comes out and says something on currencies, presents a united front, I think the G7 tends to get what G7 wants. Now, would that positive result come from just the result of a communique or a statement? Perhaps not. They might have to actually intervene in the market. But if you take the maxim, don't fight the Fed, then why would you want to fight the G7, the Fed plus 6 others?
Yeah. So here you talk about people that are skeptical about it having impact and having lasting impact. You give some examples of, why don't you talk about prior examples of when central planners were effective in the currency markets intervening?
Well, they intervened. I mean, the history of G7, well, certainly say, for example, since the launch of the euro, we all recall that a year, 18 months after the euro was launched, it was tanking. It was launched at 117. It got down to around 82 cents.
Yeah.
What happened? The central banks came in, and I think the euro virtually doubled over the next, 15 years or so. We got up to, what was the high in the euro? I can't recall, but 160-ish.
Yeah.
Now, was that all down to G7? No, of course not. But again, and then you go back further to 1985, in Plaza, when we had the Plaza Accord, dollar was much higher than it is now. The Plaza, I think the dollar had already started to turn. We had the Plaza Agreement, and the dollar virtually lost about 50% of its value in the next 18 months. So much so that we had to have the Louvre Accord about 2 years later to try and bring it back up. So the G7 can, and it has the firepower and it has the authority, I think, to if it wants a turn in the market, it can achieve that turn. Now, it may have to time it well. It may have to, however it words it, or the way it does it might be open to question. But I think if it really wants to stop the dollar from going up, I think it can.
Okay. And if China's not included, you have a caveat here that the whole thing could be torpedoed by China.
That's a difficult one. If the G7 wants China to, but again, the US and China don't see eye to eye on much. I think that's right. that's something of an understatement. It's not controversial. However, the stability of the global financial system, China has an interest in maintaining that. The US has an interest in maintaining that. They're codependent in many ways, and the most obvious one being, China's trade. Holdings of treasury. Well, there's trade, there's world trade, there's trade between the two countries, but China's holdings of treasuries, it may not be getting the news and the attention from people in the market or people like myself as much as it did perhaps 10 years ago, or pre-crisis. But China still holds probably over $1 trillion worth of treasuries. Its reserves are still around $3 trillion, most say 60% plus perhaps of that in US dollars or dollar assets. So they have a mutual interest in not wanting that whole system to unravel. So might we get China to sign on to something, or to give a nod or a wink to any G7 communique or stance on the dollar? I don't know. I don't know how that would work, but I do think it's not fanciful to think that China and the US could see eye to eye on that.
Okay.
Especially as China wants the dollar to stop rising and wants the yuan to stabilize.
Okay. So it's in the interest of almost everybody. And do you think that it actually gives the Fed cover to keep raising rates? Because if the dollar weakened, it would nominally support commodity prices and make inflation stickier. So they would, have cover to continue to tighten.
It's a tricky one because on the face of it, you would think that the strong dollar, the rising dollar is good for the Fed in its fight against inflation, which it is. But I would suggest that it's maybe not quite it's not quite as influential as you might think. Obviously, all these commodity prices and energy prices, oil, etc., is all priced in dollars. The US is a relatively closed economy compared to the big economies in Europe and in Asia. So the impact of the dollar on trade flows and import prices in terms of trade, etc., is not as strong as it is for other major economies. So the dollar rising is, the Fed is quite happy with that, and I think we've seen that because the Fed hasn't said anything really on the dollar. It's been made no public effort, at least to rein that in. Could the Fed swallow another 5-10% rise in the dollar? Yes, but equally on the other side, given that the dollar's impact is not as powerful on US inflation, could it swallow the dollar coming back down 5 or 10%? Probably yes as well.
Okay, so it could be a sacrificial lamb here. And
I would say it's more of a financial stability issue. I think as we just talked about the dollar wrecking ball. I think if it starts to rock financial markets, I think it's more of a financial stability issue, perhaps for the rest of the world. That's when it becomes an issue for the Fed, as opposed to its direct impact on inflation, because its direct impact on inflation isn't particularly strong, or not as strong as we might think it is.
So why don't we move to the future, Jamie? And
as one of your guests just said before, it's impossible to predict.
Well, there's already talk about the November meeting of the Fed that they're not going to go 75, that they're going to go 50. We're going to have some inflation news or something like that to reinforce the fact that they could pull back a bit. And that's not a pivot, but you're throwing a bone to the market that we're hearing you a bit. We could be getting closer to the end, but it doesn't mean we're going to ease again. It just means the rate of increase is slowing, like inflation might be.
Well, that's that. I think everything, all these markets, the pricing of financial markets now hinges on that. As you say, a pivot does not necessarily mean a switch to easing, although there's still easing priced into next year. Just before we started speaking, I was looking at the 2023 SOFR curve, and we're looking at 25 basis points of easing is still priced into next year. Now, 25 bips is in the grand scheme probably neither here nor there. And it was only a couple of months ago that about 65 bips of easing was priced into next year. And also, I think we're looking at since the Fed last met 2 weeks ago, or was it last week? We've had about 40 basis points of hikes taken out of the short-term curve. So the terminal rate is now down to about I think what 4.35 now is the terminal rate for March, June next year. About 2 weeks ago, it was up to 4.75, 4.80. So the market is already, as you say, starting to price in a slightly less aggressive Fed, and I think that's fair. I think, as you were discussing in your last show, some of the economic data is going to start to turn. We've got ISM data coming out soon. I think some of the hard data is going to start to soften. Maybe payrolls is going to start to soften too. And that's understandable. I mean, you don't have this degree and pace of rate hikes, financial conditions tightening without it having some sort of economic impact. And I think the landing strip for that soft landing is getting narrower and narrower. So some sort of Fed taking its foot off the pedal is to be expected. And again, just before we came on, I was looking at break-evens. You're talking about inflation and inflation expectations. There's been a dramatic fall off in break-even inflation rates. 5-year and 10-year US break-evens are now down to about 2.1%. So that's back towards basically Fed target. So if you take break-evens as a guide towards the markets, to where the market thinks inflation is going, you can say that the market thinks the Fed's going to be bang on, is going to do its job, and inflation in the next few years is going to come back down straight towards target. We had the UMISH expectations, 5-year expectations on Friday, again coming down to 2.7%. That's the lowest in about 18 months. So the market thinks the Fed is achieving its goal on inflation. Again, whether that's within the next year or 2 or 3 years, we're not quite sure. But inflation expectations are certainly coming down. Oil prices are down, to $80, $85 a barrel now.
Yeah,
we're much higher than that. And the year-on-year increase in oil is back down to about 15% from way. So the signs are inflation is starting to moderate.
That'll be the next story. So will we shift from worries about inflation to worries about growth?
Most certainly.
And that could be behind an interest rate abatement of the pressure. In fact, we're already starting to see it. Maybe this high that we had in the 10-year at 4% might be a marker for a while.
Well, if you think inflation's coming down, and it seems to be, or certainly inflation expectations are coming down. If you think inflation is going to come down, if you think temporarily, but certainly come down from the 8, 9, almost 10% levels, and you think the Fed tightening is having its desired impact, you think the economy is going to slow, possibly go into recession. I think recession sometime late next year is not an uncontroversial call. Put that all together, and you see the 10-year yield at 4%. I think a lot of investors might think, I'm going to lock in at 4%.
Yeah.
And again, that's not particularly uncontroversial, especially when you see, as you were also talking about earlier, some of these calls on the S&P. I think we're down past the 3,600 target that many people had. We're now looking at 3,400. Again, you can argue, are we due for a bounce? Probably yes. But
it looks like it.
It looks like it, and I think there was a great stat from the guys at Carson Group, Ryan Detrick. I don't know if you guys follow him on Twitter, but he was pointing out that the S&P 500, the start to the year has been, as we all know, one of the worst on record, and I think only since the Second World War have we had worse starts to the year for the S&P, and I think that was 1974 and 2008. Now, what's interesting about those years is that in Q4, after this horrendous start in Qs 1, 2, and 3, guess
Big
what?
recovery.
The S&P, 7.9% in both years. Quite coincidentally, it was 7.9% in Q4. They bounced back. So we could be in for a bounce. However, having said that, if you think the financial environment, the market environment, and the economic environment are still pretty, I don't know what word to use, grim, dicey, uncertain, and you're seeing treasuries at the safest asset on the planet at 4%.
There's competition now.
Yeah, I think that
there is an alternative.
Equity risk premium is maybe in favor of bonds right now.
Yeah. Okay. What a great interview, Jamie. And so what I want you to think about is the biggest financial story, I think, since Nixon closed the gold window for our next discussion. Your views on the CBDC. And what do you think it's going to be? Why are you laughing?
Well, but it's not because when you're kind of in the weeds and you're being distracted by what's going on on the screens in front of you, it's hard sometimes to take a step back and have a look at those multi-generational trends.
Well, how far away is it? I hope 20 years, but it's not, Jamie, is it?
No, these things will creep up. But I think the biggest story right now, and as we've discussed, is the dollar and the tightening of financial conditions. And are we getting closer to a point where we get some sort of action, whether it be verbal or otherwise, from G7, I would say, or authorities on some sort of coordinated action?
Okay, so Jamie McGeever and Dale Pinkert calling for the cavalry. It's time for them to step in, right?
Well, if they don't step in, if they don't do anything, does the dollar just keep on rising and rising?
Yeah, bail out the world, Fed.
And if it does keep on rising, that is unsustainable, and something's got to give. I wouldn't say break, but something's got to give.
It sounds a lot less expensive to take the dollar down. Isn't it easier to debase your currency than to make it go back up when it's in trouble?
Well, the Fed. I mean, I don't think the Fed would get in selling dollars, or perhaps it would give a nod and a wink to other central banks to do that, like the Bank of Japan, for example, or maybe the Bank of England. And we've not even spoken about the ECB in this half an hour, but they're under huge pressure too, and the euro's going down, and they face a tough winter, energy prices, a falling currency, high inflation, 17% inflation in the Netherlands. 17.
Yeah. Aren't you in Florida, Jamie?
Yes, I am. Okay,
were you a Spirit?
Yes, fortunately, the house is still standing, as you can see. But yes, I'm in Orlando, East Orlando.
Okay, it got bad there for a while too.
It did get bad, and when I was outside, there is a lot of damage around. We were spared, but there is damage around, and it was. I think it's been pretty tough for. I mean, we had friends of ours who had to be evacuated, only 5 minutes down the road.
Yeah, it makes a trade that doesn't work look small.
Yeah, I think there are much bigger problems in the world than whether the dollar's going to 145 or 146 yen.
Well, grateful that you're okay, praying for the people of Florida. You don't know if you have faith till you need it. And thanks for a great interview and like-mindedness about what central banks may need to do. Appreciate it.
To watch. Thank you very much, Dale, and speak soon.
Follow Jamie at Reuters Jamie for a great resource for knowing what's going on, not just the Fed, but everything going on. One of the best columnists at Reuters, Jamie McGeever. We're fortunate to have you come and edify our community, Jamie. Thank you.
Very kind of you to say so. Thank you very much, Dale, and speak to you soon. All the best.
Okay. All right. Jamie McGeever, everybody. Thank you for your attention. You could join the team in 11 minutes on the Morning Edge. Don't just count your pips, count your blessings. And let's have the cavalry ride to the rescue. Thanks again, Jamie.
Thank you.
Adios, buddy.
Bye-bye.